Alright, so we are going to be talking about risk management in forex trading. So, what is risk management? Risk management is a crucial part of successful forex trading. It involves strategies to minimize potential losses while maximizing profit, ensuring long-term sustainability. Alright, so risk management is what keeps you in the game. Risk management is what protects your capital. Actually, the first thing that we do in risk management is first in forex trading is to protect capital or secure capital so that we can be able to make, because once you secure capital there's always a chance to make money. So but risk management, when it's just enables us to be able to, while we place a trade, we reduce our losses and maximize our profit. That is, if you are ready to lose like $10, you'll be able to gain something like 30 to 40 or $50, even $100. So you can be able to see how you reduce. Let me say you have $100 account now. You have $100 account, you lose 10, and then but you are potentially getting like $50 to $70. So that's what it means to minimize your loss, maximize your profit. Yeah. So we have potential sizing. Position sizing. Position sizing determines a number of lots or units to trade based on traders' accounts, risk tolerance, and stop loss level. So this is how it is. So it depends on your lots. Like when you are trading, you will know what is lot. Aside from leveraging, lot size is also different. Like you will know what you want to look risk, what is your risk tolerance, and stop loss level. You will know it. All these things we will be able to, because you cannot just put any stop loss anyhow. Lots anyhow. You have to be careful. Understand? So steps to calculate position size. Determine risk per trade. Risk a fixed percentage of your account balance. That's 1 to 2. Yeah. So if you have $100, okay. For example, if your account is $10,000 and you risk 1%, the maximum loss per trade is 100. You see it. So know how to use 1:2%, 1 to 2% of your account balance. That's what it is by this thing. When you risk, if you can risk that amount, even if you have $10, you risk $1. That's 1% of your trade. Is that 1%? That's 10%. But you get what I mean? Like just 1 to 2% of your trade, of your balance. Then you can be able to use it per trade though. There's a maximum, and you're able to get, and then you maximize your profit. So this person now is losing $100, but the person can potentially be getting something like $1K. You feel that? So set your stop loss distance. Measure the distance from your entry point to your stop loss in pips. Well, pips is the amount of like the movement of price anytime it moves. Anytime the market is continuously moving, that move, all those small moves, they are what we call pips. So if your stop loss is 50 pips away, your risk is 100. All these things I don't really need to explain for you. What you just need to do is put your stop loss close to your entry point, so that you will not really close per se, but is as we said before, risk management is all about your what risk tolerance. If where did I it? It's all about your risk tolerance. Yes, what can you risk? That's what it is. It's not about anything. So you need to know what you can risk in this position, like risk tolerance. So your stop loss, you put it below or above your entry point. So that's just how it is. So diversification is another one in risk management. Diversification reduces risk by spreading investment across different currency pair market or trading strategy. What it means is that instead of just taking one trade, one pair, you can be able to go to, like, let me say there's volatility 100, there's volatility 75, volatility 255, 250, yes, 1s. You can just go, instead of just focusing on like volatility 75, you can go to, you can go and trade here, trade in 100, trade in 200, understand? So that your money can be able to spread. So they're saying trade correlated and uncorrelated pairs. Just just shall trade everything if it's possible. Right? Not necessarily everything, but you should not just be fixated on just one pair. That's what they're trying to say. All these things don't really matter. So use multiple strategies. Combine different strategies like trend following, range bound, and breakout trade. I don't need to explain this. What they are trying to say, just basically know what you are trading. Use different strategies. Put your stop losses. All these things is risk management, so that you can be able to minimize your risks. You know how you trade as you continue to trade. Like, as for me, I trade reversals. That's breakout trading. So once there is breakout, I'm always in. I always love to trade that. Trend following, I don't really like it. So that's just basically me. So limit exposure per pair. Avoid allocating too much capital to a single pair or trade. It's the same thing we have been saying since. That we are saying in this trade correlated and uncorrelated pairs. So that's just it. Just don't put too much capital in. No, actually, what they are trying to say is, in a single pair, don't go and carry, like, let me say you have $100 now. You now say, let me go and risk $50 and chicken side. No, don't do that. You need to be careful. The goal is to save your money. You understand? Save your money. Just don't do that. And then, even if you are doing multiple things, don't use too much for it. Avoid over leveraging. Leverage allows traders to control large positions with smaller amount of capitals, but excessive leverage increases risk. You see, it helps us to be able to enter trades, but much of it increases our risk. The way price will move, and yet our money too be going so fast as well. So that's why it is good to avoid over leveraging. So we use low leverage ratio. It's a limit leverage to 1:10 or 1:20, especially for beginners. If you go to the reef, there's nothing like, I don't think there's anything like 1:10 or 1:20. This is just like common stuff for everybody. But in the reef, I think it is from 1:500 to 1:1000. So just the thing is, don't over leverage. Don't go and put if there's 1:2000. Don't go and do that. Just be careful. Control position size. Do not open overly large position relative to your account size. That is to say, you enter one trade, fortunately for you, glory to God. Then now, you can enter a trade many times. In that same place where you can enter that place many times. So you are now, let me say you have $30. You enter one trade, you have risk 10%. What's 10%? Let me just use 300k. Sorry, I say 300k. Let's say $30 and use 1%. 1% is like $3. Yeah, let's just do that. And then you now say that you want to place 25 trades. Should it 25? No, not 25. You want to place like 16 positions. 3 times. Mistake, sorry. you now want to put something like 8 positions. It's so close to 30. You put like 8 positions, so it's close to 30. If you do that, your money will just vanish. If the trade go against you, you are lost. That is not risk management. That's so bad. So control your position size. Yeah, control lot size too. It directly impacts the level of risk in a trade because it determines the value of a peak movement. Proper lot sizing is crucial or critical to maintaining effective risk management. Unlike leveraging, where you put it so that you can be able to enter a trade, lot size is not there for you to be able to enter a trade. Lot size is going to determine how much money will be entering your account because lot size has to do with leveraging too. You put too much lot size, you make too much money. You put too much lot size, you lose too much money. So you need to be in control of yourself. Let it not be that you are driven by money. So this is just how to protect your money to the potential risks that will potentially carry you to your village. Additional risk management tools we have set your stop loss and take profit. Always set stop loss. Always use stop loss. Always use it. Take profit order, lock in profit. Use stop loss. It will help you. Not that you not put stop loss, just enter market. If market go against you, all your account is gone. You should protect your fund, your capital. Maintain a risk to reward ratio. Aim for a ratio of at least 1:2, meaning the potential reward is twice the potential risk. That's just it. So that's always look for something like this. That the reward is twice the risk. That's all you need. Thank you.